Today, we will talk about accrued interest and how it impacts accounting and bond transactions. Accrued interest refers to the amount of interest that has been incurred as of a specific date on a loan, bond, or other financial obligation but has not yet been paid. Accrued interest can be for the lender or the borrower, and it is important to both because it represents an obligation or a revenue that will likely be collected or paid within 1 year. Accrued interest is calculated for the last day of an accounting period and is recorded as part of adjusting journal entries at month end. It is reported on the income statement as a revenue or expense depending on whether the company is lending or borrowing. In addition, the portion of revenue or expense yet to be paid or collected is reported on the balance sheet as an asset or liability. Accrued interest is a result of accrual accounting, which requires that accounting transactions be recognized and recorded when they occur, regardless of whether payment has been received or expended at that time. This kind of accounting recognizes revenue when it is earned, not when the payment is received, and reports expenses in the same period as the related revenues. Accrued interest is calculated and posted as part of adjusting journal entries at an accounting period's end, as reversing entries. This ensures that the net effect of the revenue or expense that was earned or incurred in the current period stays in the current period. Accrued interest is equivalent to the accumulated interest that has yet to be paid or received as of the end date of an accounting period. Accrued interest is an important consideration when purchasing or selling a bond, as it represents the interest that has accumulated since the previous interest payment. The accrued interest must be paid to the previous owner when a bond is bought or sold at a time other than an interest payment date. The amount of accrued interest can be calculated using day count conventions and is added to the face value of the bond to get the purchase price. Here are 3 key takeaways. 1. Accrued interest is a feature of accrual accounting, and it follows the guidelines of the revenue recognition and matching principles of accounting. 2. Accrued interest is booked at the end of an accounting period as an adjusting journal entry, which reverses the first day of the following period. 3. The amount of accrued interest to be recorded is the accumulated interest that has yet to be paid as of the end date of an accounting period. Hope this would help. Thanks for watching.